Today I'm going to give you a look behind the paywall. Well, it's hardly pay, it's barely a wall, but that's what we do in our virtual trading floor when we're not on air. Nick is giving a terrific rundown of the markets. Stay tuned.
Tear down this wall.
Because I actually wanted to pick your brains. Are we getting a sovereign debt crisis, Nick, which is blowing in all our faces soon?
So that's a good way to start this meeting, I think. So
Always start with positive.
I think that was positive, actually. So look, America is the only country in the world that can do what it does, right? So when it says we've got a problem, then they can just go and print and, you know, everyone swallows it. Yeah, it's not like the Brits where they say we want a growth plan. And the moment they say growth plan, you know, all the gilt investors say, oh, a growth plan, we need to spend, we're going to spend money and the deficit is growing up. So basically everywhere except the US has a newer problem because of what's going on with tariffs, what's going on with the geopolitics. Everyone's now got to look after themselves. And so this is why they have to issue a lot more debt, and then they have to sort of rethink what they're going to do, and they can't follow their pet projects and the like. So it is definitely a problem for Europe, definitely a problem for potentially Japan, less so Japan, but it nevertheless is just as important. And certainly the Brits are going to have this problem. And so gilt yields are, 30-year high. Yeah, I mean, still from when I was growing up, that's pretty low, but gilt yields are 30-year high. And so the question is, when does it really become a problem, and what are the governments going to do about it? And one of the things that you and I talked about many moons ago, and also last July, when we talked about the Japanese repatriation and then in August when it was the carry trade, and we're saying, well, okay, well, this is it then, isn't it? This is more Japanese repatriation. So imagine this. Obviously, Trump's plan is all about getting the deficit down. So how are they doing that? There's a number of things. Firstly, tariffs. Tariffs have almost totally offset any new tax giveaway from, this big, beautiful bill. Secondly, we know that eventually, once Russia signs some peace agreement, that some months later, he's going to go to the Chinese and the Russians and say, cut your deficits, cut your defense spending by 50%, we'll do the same. So that throws another 400 million into the pot, where it reduces the dependency on US treasuries. No one else can do this, right? So he's doing that. What else is he doing? He's doing stable coins. So people to buy the dollar. What is the dollar? Dollar is basically treasuries. What else might he do? And this is the, sort of the latest speculation, if you like, is the cutting the interest on reserve balances. Currently, money put by JP Morgan, or money which is given to JP Morgan as part of the quantitative easing, in their reserve box, they get paid 4.4%. So if Trump says, well, that's going to go down to 0 or 2%, it forces JP Morgan to just go and buy treasuries. So even more buyers of treasuries. So this is something that Trump is actually able to do, improve substantially the US debt to GDP. At the same time, the Brits have to spend more money, the Europeans have to spend more money, the Japanese are spending more money. And why? Because they now have to sort of encourage growth in their economies, because the tariffs are also going to be biting them as well, because they're less competitive products and the like. So do you honestly think that the Brits and the Europeans and the Japanese will continue willing or freely to be allowed to invest in US treasuries? And I think, and what I talked about last year, and I still maintain this as being an issue, I think they will be curtailed to some extent, because they will be forced to buy their own government bonds in some way, shape or form. And forced probably means morally forced, otherwise they're going to be in the newspaper. And if that doesn't work, then I'm sure they're going to force them to invest a certain percentage within the UK. Could also mean UK stocks. And so the Europeans and the Brits and the Japanese, if things continue, it makes life difficult for them. Why does it make life difficult for them? Because the government in power, just take the Brits, for example, the government in power have their backs to the wall. They've got so much in terms of tax revenue, but even if they increase the tax revenue, their expenditure is on an ever increasing path. And why is it on an ever increasing path? Because there's no growth. The growth is not growing fast enough. But the last time a government tried to improve the growth, the prime minister got kicked out. So, they are stuck. What can they do to resolve the problem? They'd like to grow, but they'd also like the gilt market to give them time. But the only way they're going to give them time, as I say, is to solve that problem, and that is to kind of prevent more money from leaving the economy and going to the US. So you could have a problem if things continue to spiral. Well, I won't say they're out of control at the moment. As I say, Japanese foreign debt is probably 11%, 12%, something like this. So they don't care really. But, they will care eventually, or the rest of the world will care when the Japanese realize that actually they're getting a return on their bonds, whereas their unhedged treasuries are going to be losing money because the dollar might go even lower, right? So that's when the problems start to come. What does a debt crisis mean? A debt crisis means, well, the government's going to pay its debts, but the question is, what do they allow their investors to do? And that's how you solve the problem. But it could potentially lead into this notion of net international investment position in America is everybody else owns NVIDIA. So if they're going to sort of put money back home, they're going to be selling NVIDIA and they're going to be selling Microsoft and all of this stuff that they've been buying. So that's what the crisis looks like.
Follow-up question on that, Nick, because I'm biased. I've been in London when the Bank of England blew it up the last time in 2008 by massively inactivity towards the financial crisis, when you saw people queuing up for the first time in front of a bank. I still believe that's what caused the whole shenanigans. Anyway, the Brits are now in this bizarre situation. They've lowered interest rates at the short end 4 or 5 times in a row, and 30 years are going through the roof. We are now at levels that are far higher than when Miss Truss tried to, have the economy grow with a tiny little tax cut she was proposing. So they blew her out of the water. Sue told me that we have now the situation, as you just mentioned it, the French have to pay more, the Italians have to pay more, the Germans have to pay more, and there is the British inability to actually solve this problem. They simply won't be able to do it. When all our debt in the whole of Europe is being pushed up because the Brits fuck it up again, France is the next one to topple, and then people will start looking into Germany. Is the only solution then to save it Eurobonds? Or will it break off the system? And that still hasn't saved Britain then.
Whether they do Eurobonds, I think it's a different topic. They will argue all sorts of things in order to get to the Eurobonds thing, because that's ultimately where the leaders want to take Europe at the end of the day. But as I say, for the Brits, I think realistically their only solution is to buy time. So what Liz Truss should have done, or Kwasi Kwarteng should have done, there was nothing wrong with the plan, but he needed to have lined up buyers of gilts before he published the plan. He just went out with his mates at Goldman's, published the plan, and then said, "Oh shit, I forgot to close the door at the back here," because that was just careless in my view. But there was nothing wrong with the plan of the government at the time. It was just the execution. They needed to do what I think they need to do now, and that is to solidify the gilt market. And how do they do that? As I say, force people in the UK to buy them, force the savings institutions not to be buying treasuries or so much treasuries, but to be buying gilts. It buys them time. And that's when they have their time then to implement they'll dust off the Liz Truss plan and say, well, they'll call it the Keir Starmer plan, and it would look very similar to what
is that the financial repression you and Russell Napier were talking about?
Yeah, but it's a different thing, I think, these days that, I won't say I've moved off that because, the plan of Trump is not financial repression, in my view. The plan of Trump is right now is almost, as I say, I mean, our last video, I talked about deflation as a risk, and I still maintain deflation is a risk. And why is deflation a risk? Because the only true solution that nobody wants to talk about in Europe or Japan is to say, well, actually, we're going to cut the deficit by putting up VAT by 5%, putting up income tax, wealth tax, property tax, council tax, you name it, because they won't be in government for much longer. So how do you avoid that, right? And I don't think that you avoid that necessarily by any other means than implementing growth plans, because the tweak on growth to debt to GDP level has a very, very large effect at the back end of the curve. And, I think the reason that the gilt market run away and the European market is yields are going up is because nobody can see a plan. There is no credible plan on the table to get growth. And I think, the German plan, well, let's build a few tanks because that's all they can do to boost the economy. It's not really enough. It still hasn't given up.
Correct me if I want to know whether I got that right. So if we have something like the plan in the UK could be, yes, you have to buy gilts, insurance companies.
That's to buy time, just to buy time.
That means repatriation of stuff that is at the moment parked in treasuries going into gilts again. So treasuries are being sold off, and Europe, France might...
Or US assets are being sold off, yeah.
Yeah, well, that's the question. US assets in general, I would rather sell a US treasury than sell a good high-performing stock which can pass inflation on to the customers.
Well, it depends if you want to buy a sort of a US stock which is overvalued, and if the market environment is right at the time. So, we don't know what
it's
that
only
looks
overvalued
like.
in the paper money they call money.
Yeah, I think, it will be, reality is it will be a bit of both, right? So when we talked about, I mean, this is all about Japan. So when we talked about Japan, we talked about, the repatriation as such. So the Japanese have, look at what's going on in Japan right now. So the currency is a little bit stronger, but it's nowhere near as strong versus where the interest rate differential should be. Why is that? And why is that? Is because the Japanese banks are losing money as the price of the bonds, and it's the same in the UK and the same in Europe, as the price of the bonds goes down, people who are leveraged buyers, and the Japanese are leveraged buyers, they're losing money. So what do they need to do? Well, they need to sort of fill the gap. How do they fill the gap? Two ways. One is actually sort of borrow some money to, finance their, the negative margin call, if you like. It's not necessarily a margin call, but yeah, let's talk about it like that. Or you say, well, then I've suffered the loss on this asset for too long. I'm going to sell this asset. Now, what is the leverage that's in the system? I don't think it's leverage to go and buy US Treasury bonds. So I think the leverage in the system is going to go and buy equities. So all the carry trading that's been going on, sell the yen, go and buy some risk assets, sell the Swissy, go and buy some risk assets. I think we are entering, don't know when it starts. I think the next phase of this thing, we don't know when that is likely to kick off. But I'm sure it's a lot nearer today than it ever has been, purely and simply because of where yields are. So what they'll do is they'll say, okay, then I have to exit my position because I'm incurring losses somewhere. Okay, I need to sell something, get out of this sort of dollar position, and fill this loss with profits on gold, profits on Nvidia, profits on wherever else. And I think that's the kind of nature of what we're facing, I think, to solve this ever rising level of yields, which at some point for some countries will be very painful. As I say, I mean, France, we don't know. France has got an awful financial position because it went, on a borrowing spree because it was theoretically close to German debt. So they said, our spread to German debt is like 10 basis points. Let's go and sort of put some of that stuff out there. And now, I don't know where they are, but a lot wider. That's the point.
There is, the old relationship that equities, especially tech, is the longest duration asset you can possibly hold. It's not like 10-year bond, 20-year bond, 30-year bond. You have discounted all these cash flows from eternity with huge growth rates up down to today. If now in the US, I think the 30-year touched the 5% the other day, rang a little bell. And we have that scenario you just described. How do I still get that together? Because on the one side, what I said earlier, if paper currency is just paper, then the stocks are not extreme. There is no extreme high valuation towards it. It's just the paper money isn't worth anything anymore. However, in that framework, interest rates go up, especially on the long end. What's the implication on 30% of the S&P 500 is now tech in valuations?
It's not going to be a pretty picture for those people who do DCF calculations, right? But as I say, the way that I read the kind of the political agenda in the US is he's actually doing, Trump and Besant and co are doing something for the deficit that I don't think has been thought about. I don't think is necessarily in focus by normal people, put it this way, because they just see it as, stock market's going up, Trump's, good for the economy, go and buy some stocks, it'd be a great thing, and so on. But Trump and Besant, I don't think are focused on that because the strength of the US is not necessarily Nvidia. The strength of the US is the power of the dollar. And therefore, they will do whatever it takes in order to secure the power of the dollar. And remember, right now, the power of the dollar is under threat from, BRICS. It's under threat from commodities being repriced in Chinese currency. It's under threat because the foreign central bankers have been buying gold because they saw what happened to the Russian assets that were frozen. So we know what the implications have been because of that kind of stupidity, if you like, from the decision makers. And I think that Trump is trying to reverse some of that. Whether he succeeds or not, don't know. But the first step is tariffs. Tariffs are a tax. So the first thing is he's now introduced. We see if the courts, eventually allow it. It should. I'm sure if he wants tariffs, he'll get them. But he has managed to secure 30 billion a month. That's 360 billion a year. That's 3.6 trillion over 10 years without inflation. How much was his big, beautiful bill of new tax cuts? Less. That means net is actually sort of reducing the deficit. Imagine he manages to cut defense spending. Imagine if he reduces the interest rate cost on the debt because he replaces Jay Powell with somebody who's going to get rates to 2.5% or whatever it's going to be. Imagine if he saves money by not paying the US banks 4.5% on 3 trillion a year, right? Which is what they're doing today. I mean, Jamie Dimon, is a billionaire, but he's a billionaire because he's been getting free money for the last God knows how long. And size, and he didn't have to do anything for it. So, he can say, hey, I made 100 billion this year. What did you do? So this is something that I think he is steering, turning all the keys and things that he can influence. And the goal is to actually get the deficit down. And I think along the way, the first thing that happens is tightening of the belts. That's why I say deflation is a risk, because the growth that comes from all of the other plans he's got, reducing taxes on tips and all of this other stuff, and reducing bureaucracy and so on. Perhaps the benefits come later on for the US economy. But initially, I think there'll be a bit of a shock. And I think the bit of a shock may already have happened, not necessarily just because of Trump, but I think because all of the spending policies of Biden have kind of run their course. And I think right now you're seeing that through lower GDP forecasts, unemployment numbers at risk, so employment numbers certainly looking more downward path rather than the upward path. So I think in the near term, you've got this sort of potential risk and potential shock. And I think that's, as I say, I'm not a seller here of treasuries. So whatever is going on in the UK, in Europe and Japan, I don't think the same thing is happening in America. I think they are able to do something both ways. They can print and they can buy this stuff. And, the rest of the world is wishing they were in the same position.
So where does that leave us? If I sort it in now, S&P, obviously that's my focus of interest. We are 6,500. And long-term interest rates just touched 5%. The market is wary. There could be contagion coming from Europe, and you even forecasted the deflation scenario. Well,
Yeah.
are we at the top, Nick, or are we not? Because I
Well,
almost had
you
the
could call
impression that inflation
you
would
call
be
the
better
top
for
when
the
you
equity
start to
market.
see it go down. Sorry. Yeah, you call the top when it starts to go down, because if you can, and I'm guilty. I've looked for places to hedge. You're going to lose money. It's like you put on the trade and you're guaranteed you've lost some money, but you feel comfortable because you've got portfolios on the other side that are going to actually be winning, but you just lose some money on some put premium over here. And if you've sized it right, you've lost a small and you still made okay. But where are we in the technical position? We are, so there are kind of a number of moves, but the bigger move obviously is the one from the low on the 5th or the 8th of April, right? So this move is either over as of last week, or it is one more move to go before that final high. So, however you count this thing. So then it's likely to see a retracement, in my view. I mean, we must expect that. But the retracement is a small retracement. Let's just say it takes you from, where are we now? 6,500. Let's just say it takes you to 6,100 to 5,800 on the low, right? Somewhere there. It's going to look ugly. People say, oh my God, what a disaster. But from a timing perspective, it still looks okay for higher prices towards the end of the year. So near-term correction, don't know when it starts. We may have already started. But at the moment, you've still got some tailwind for the US equity markets. But come towards the sort of first quarter of next year-ish, that's where you want to be a little bit more cautious, because if this was a first wave, I mean, it was a hell of a first wave, but it's likely that those other waves will be far shorter, that this was the big move, but the reality is, the other legs of the rally won't be as large. But you're still looking at, potentially 7,000 by the end of the year as a good possibility. And, what I've been looking at is to say, okay, I've sold a lot of my US stuff, and I've been buying China, I've been buying, gold mines or gold or whatever, something to sort of replace the stuff that I've sold. I've even bought bonds, right? Because I don't think bonds are a silly investment right now. Not European, of course, and then we must consider the dollar. Dollar is actually the most important part of this piece, because all of the volatility that is likely to kind of come at us possibly at the end stage, but even in sort of different phases in between, is what's going to happen to the dollar. Now, if you look at a chart on the dollar, I think about 2 years ago, I said the dollar index, and it was trading at around 115 was the high. And when it started to turn, I said 94. And everyone said, you're crazy, it's not going to happen. We got to about 96 a few weeks ago, the dollar index. We're now at 98. And everyone I speak to, and even I sort of put out, you can take a long dollar position. I did that about a month ago. But the dollar is influenced by two factors. And the main factor, obviously, is interest rate differentials. And with interest rates going up in Europe, in Japan, and in the UK, the differential to the US rates is narrowing. And as it's narrowing, the value, if you like, of dollar in treasury investments for foreigners or US investments for foreigners is a lot less. So that's why there is a risk of even more downside for the dollar. And if you think there's going to be more downside for the dollar and you're unhedged, right? You're a Japanese investor and you're unhedged in NVIDIA, then you better hope the NVIDIA stocks goes up faster than, I'm losing on the currency. Ignore the fact I might need some money to cover my margin calls, right? So this is the thing that people have to put in their heads. It is the wish of Trump to cheapen the dollar, but it is also the wish of Trump to stabilize the use of the dollar. So he's trying to sort of do two things that seem impossible. Well, how do you cheapen the dollar and still want people to buy it? And as I say, the way he's doing that is through other mechanisms, stable coins and the like. So the answer to the risk question is, it doesn't look like it's over full time yet. But as I've said for a long time, that 2026 is more likely the end of the cycle. And the other risk asset, Bully's favorite asset, is Bitcoin, right? So we don't know. I sold 2/3 of my Bitcoin longs at the high. I mean, really was the high. It was, and then I put on a tactical short because I thought, okay, I think this thing is going to see a retracement. We don't know how deep a retracement. And I put 103,000 was the sort of, if for longs, a stop level somewhere around 103. That would be the point where you would be nervous as a long, because that opened the door to a much deeper retracement, in the 90s, in the 80s, and so on and so forth. So we did see a tactical sell-off, but we got a good bounce from around, I think it was 107. And I looked at the chart today. There was a DeMark sort of counter trend thing on Monday, which has given a good, let's just say, reason for a recovery in Bitcoin. But again, the move up in Bitcoin is not enough to give us confidence that the low that we saw was anything other than an interim low. And we still don't know if there'll be a second larger leg down or third leg. So 1, 2 up, what we saw today to, I don't know, where are we, 112, 113. And at some stage it comes down again. So that's still open as well. So the answer to that is, I don't know. If you look at foreign exchange, it's like this. I don't know if you saw the yen yesterday. The yen was super strong and then super weak. If you look at TLT collapsed and then it's recovered today. Tariffs legal, tariffs not legal makes a huge difference for the deficit, makes a huge difference for, the treasuries and their outlook. And the moment you change that, you change the currency. The moment you change the currency, you add volatility into risk assets. And what we're seeing right now is chop, chop, chop. I'm trying to ignore the noise and say, if I take the noise away, what do I see? I see more chances of bonds going up than down. I see more chances of a near-term correction in stocks from either the level that we saw last week or, shortly higher, a little bit higher from where we are right now. So I am short of stocks from last week, so looking at that as well. But still a longer term, till the end of the year, chance of a decent recovery. But then that's it. We're not in that trend phase. Everyone wants to know, well, should I be sort of putting money in? We're not in an easy trend phase for risk markets. So when things are going like that, it's okay. Anyone can make money. We're in this stuff right now. And when you're in this stuff, you need to be very flexible. You need to be sort of small, but you need to be quick as well. You need to be agile. And I think that's the phase we're in for currencies and all of this stuff. So I see weaker dollar. I see the weaker dollar. Why? Because more pressure on Fed to reduce rates. If they announce we're going to force interest on reserve balances, down to 2% or $0, because interest rates will be coming down. And the moment the dollar comes down even more, I mean, you have to think about the consequences for, because of that. And this is where the volatility is coming right now. But that's what I can see if I take the noise away.
Are you going to see the long end steepening?
Well, we've already seen the long end steepening, and I think
even further when they start pushing down interest rates, even though there is inflation in the system, and the
I'm not a fan of the inflation thing. I mean, I'm not a believer in the inflation thing at the moment. I don't see that. I mean, I think let me just see if I've got.
Did you see the chart Linus posted during the day? The inflation on the fast foods industry. Ridiculous. It made me hungry. I need a burger later.
Well, inflation on, let's just have a look at this thing. Am I allowed to share anything here?
Yeah,
I've
already made you co-host.
So let's just get rid of that. Allow, I don't know what that did. So I'll just press allow. So let's just think what I've got here. So in blue, we've got real yields, right? Let's just see if I move your faces away. So the blue line here, the light blue line, are real yields, real bond yields. In other words, they're inflation adjusted. So you take the 10-year treasury, you subtract the inflation, and then what you're left with is real yield. So if you think that the bond yield is made up of inflation plus real yields, well, if you know what the real yields are, you know what the inflation expectations are. And if you sort of take a look at, God, I don't know what to do here. Don't allow. Right. So these purple things were rate hikes in the US. These green things are when the US did some rate cuts. Okay. And during the rate hike cycle, real yields rallied. Inflation was already high. The orange thing is the inflation expectation. So it's the difference between real yields and where the actual yield is. The actual yield is in red. So you saw inflation was up here in 2022 for 10-year rates. But look what's happened since about June 2022. The range for inflation expectations for the 10-year, it's been in a range of between 2 and 2.5%. So what? So if I saw this inflation expectation do that, well, then I would say, then potentially there is a risk of inflation. But as I've been, and for sure, look at this last little spike of inflation from 230 or whatever it was, 220 to 245, where we are right now. I mean, 25 basis points. There's certainly been an increased fear of inflation, but it's not running away. I don't really see that. And so, the question of will the 10-year rally because of inflation expectations? Well, at the moment, I'm not seeing it, right? I see people more scared of a slowing economy. I see people more scared of this VAT hike called tariffs in America. So that's all it is. It's just increasing the price of goods one-off. Okay, so what? That's what happens when you do these kind of consumer taxes. It's not quite a VAT hike, but imagine it is like that. So if I don't see this in the numbers, and look at this red line. This red line here is the yield of the US 10-year, right? So I think, all of the sort of things, ignore the left hand in axis, just the right hand. So this is basically saying that the current yield, what's the current yield on I haven't got the thing, but here it says it's about 420 something rather, 422, don't know, maybe, this is it's a daily chart. So 420, something like that, 422. 422, it says that here, 421. So yields have been coming down. Why have yields been coming down? I think you told me that there's a debt crisis. So you said at the beginning, we're going to have a debt crisis. I said, well, hang on a minute, let me have a look. The interest rates coming down. What debt crisis? But you've got a debt crisis in UK, perhaps, France, Japan. So the opposite is happening in America. But the question of what happens to the yield curve, at the moment, 5 rate cuts are implied by the curve between now and December 2026. So if you're looking at 5 rate cuts takes you to, what's the December contract? I think it's down to about 3%, possibly somewhere like that is the expected 3-month rate, December 2026. So the question is whether the new Fed governor is able to get rates lower. And just to say that I think there's only one rate cut forecast next year after Powell leaves. So the market at the moment is not assuming that the new chairman is going to be doing just cut, because all the rate cuts are, you can put up this tool, the which one, the CME tool. Go and have a look at the CME tool, and the CME tool effectively says the expectations of rate cuts are before. So let me just pull up something else. Sorry, bear with me a sec. Okay, that's and yesterday. So let's pull up this. So I don't know what you can see. Is that okay? Something's opening. That's good. Yeah, I think what I need to do is to give you the view of. It's okay. I'll stop sharing and then I share this thing, the thing that's trying to open. So I've got too many things open on my terminal. All right, so I should do like that. Failed to stop. Please try again. Make your documents box. I got it. You're still looking at nothing, actually, aren't you? So you are now share. Let's see if I can do it now. Got this?
Yeah, market macro report.
Right. So, I mean, if you have a look where we were 1st of August, rate cuts this year, 3 in red, 2 next year. The red line is basically saying when JP is no longer the Fed chairman. And of course, we had some, I can't remember what it was that shifted the view on this thing. It's fairly unchanged. It's just a bit of noise. You've still got 5 rate cuts, and you've still only got 1 rate cut after the next chairman comes in. Well, if the next chairman who comes in is only going to cut once, what do you need a new chairman for? Right? So you need a new chairman for the other things that he's going to do. But realistically, you would expect a new chairman to be getting rates to at least 2.5%. I think that is what is expected of. I think that's in the interview question. Where do you think the rate's going to be? And if he says anything higher than 2.5%, he doesn't get the job. So I think realistically, there's another bout of rate cuts to come. And for all the people who say, well, rate cuts are inflationary, I don't believe that at all. This short end of the curve, long end of the curve, the influence on the long end of the curve of the short end of the curve. I mean, I've done a model on, where 10-year rates are. And I think, it influences maybe 25%, 30% of the long end, you're kind of dragging it down. But still, inflation must show up in the system, and inflation comes when you kind of increase the money supply. Well, where's the increase in money supply coming from? If you're going to try and cut defense spending, if you've put a tariff tax and got 360 billion a year more money out of US corporates and the consumer, where's the new money, right? I just don't see it. So, so what's the yield curve shape? Well, if you say short end goes from, where are we now? We are 4.4. Say we're 4.4. And we go down to 2.5, that's, say, for all intents and purposes, almost 200 basis points. I don't think the long end goes to anything other than about 4%. I think that kind of stabilizes around this level, initially at least. So I don't see this as going yield curve negative. So for that reason, you would expect naturally the yield curve in the States to steepen, but not a bear steepener, as it were. So it's still, as I say, if you looked at that chart I showed, yields aren't going up in America. Where are they? Who says they're going up? And in fact, yields did go up. They blipped when the judge said tariffs are illegal. Yields went up. Why did they go up? Well, because you can issue more treasuries. So therefore, tariffs are really good for the deficit. And that's the reality. Tariffs, the tax policies, what Trump is doing is very, very good for US Treasury bonds. And that's what I think we need to kind of get in our heads. Trump is not focused on Nvidia. Trump is focused on securing the dollar. The dollar is in the national interest. And it's the most important thing that they've got. And if they don't have the dollar, they got nothing, because Russia got nuclear missiles. So what do you got that's different? And I think the thing that's different is that they still have the power of the dollar, and they want to maintain the power of the dollar. It's much, much more important to them than, pretty much some of these companies are. And for that reason, I think he is there to get the deficit down, but he's not calling it austerity. He's being sort of clever about it. He's saying, well, I'm going to put a tax here to encourage people to set up shop in US.
Well, there were a couple of rumors actually. Have you heard about the land release program they were talking about?
Yes.
There was one of the blips where he said, well, we could actually start selling the huge land holdings we have and make it more available for the people out there. I was immediately reminded of Hjalmar Schacht, how he got Germany out of the hyperinflation, because he went in forest and agricultural stuff. But I thought, okay, this could be one thing. Second, gold revaluation would also bring the deficit down.
Yeah, I mean, every little helps. Yeah, but imagine, add up all of these numbers, right? Gold, what is it? 700 billion, maybe it's 1 trillion by the time, he actually makes a decision to do it. It's 1 trillion. 360 billion in tariffs over 10 years. Now, we don't know if they're going to last 10 years. We'll see about that. Certainly Trump won't be around there for 10 years, but let's just say, doing the maths, if you're a treasury investor, that's what you're going to do. And you say, okay, 400 billion of defense spending potentially cut over the next 10 years. That's a real good thing. And you say, okay, we cut the interest on reserve balances from 4.5% or 4.4% down to 2%. That's going to save 100 billion a year. And you put all of this in place, and then of course they had to go at Doge. It didn't really do very much, but I don't believe they've given up on the theory behind Doge anyway. And suddenly all of the wasted spending has kind of gone away. And what else is going on? So they bought a stake in Intel. Interesting. What was that all about? So Intel is suffering. Intel, chip maker. They're losing money. The people don't like their chips. So they were, under the CHIPS Act, going to be the recipient of some 100 million, billion, whatever. And Trump said, well, hang on a minute. Why are we giving them money for nothing? Why don't we just use the money and take a bit of stock, and then we can leverage into their decision making? Well, that's a good idea, because nobody's going to say that's a bad idea to Trump. So, okay. What else are they looking at? They're looking at Lockheed Martin. So they've got a contract with Lockheed Martin. I don't know how big it is. I'm making this number up. Let's just say it's 400 billion over 10 years. I mean, no clue. So our friend Howard Lutnick, first thing he says is, we got this big contract with Lockheed Martin. Well, why do the shareholders get all the benefit of these government contracts? Why do Palantir shareholders get all of the government contract benefits, and it's not the government? So they are looking at actually saying, remember, America has been the gravy train for these companies in terms of subsidies, sponsorship, government contracts, all these defense. Yeah, go on, give us another 100 missiles. We'll use them somewhere. And so all of these companies, they That's why every corporate CEO is a Democrat, because that's what they did, right? They're not Democrat because they want to be a Democrat. They're Democrats because they know that they were getting the money from government. And Trump is saying, well, okay, I mean, we clearly want to make sure that we do business with American companies, but the Intel thing, the words used by Lutnick on Lockheed Martin, there's a different kind of contract that they're going to get. They're going to get a contract, but they're going to lose shares because of it. And it's going to go into this sovereign wealth fund that they're trying to build. Right? Everyone's saying, "Oh, sovereign wealth fund, they're going to ship in all the bitcoins, buy all the gold, and all of this stuff." Well, actually, it really looks like they are trying to secure stakes in companies that they anyway give money to by virtue of either contracts or, like, as I say, like the CHIPS Act, where it was decided by Congress to support Intel. And add up all of these things. That makes a really strong government.
Yeah, are we going to piggyback on that? Because in my experience, the moment a government, whatever government it is, gets involved, they never manage it as good as the guys would do without the government.
Yeah, I mean that's different, yeah, because I think if people fear that if European or UK interference in buying stakes in Royal Bank of Scotland or stuff like that, that they will interfere, and they're not experts. Well, the difference, I think, is that Trump surrounds himself with business people, not politicians, and so they will interfere when they think it's in the interest of the economy. And you see that they're looking to get rid of the Intel CEO. Well, they couldn't do that without the shares, right? So they were anyway entitled to the money because of this CHIPS Act thing. So they could have taken the money, and the CEO would have gone on happy ever after, probably giving himself a pay rise, buying back some shares, doing all the classic things that are in the interest of Democrats supporting CEOs. That's not on anymore. Now they are basically saying, okay, well, the money we give you goes into the company. You go and build another factory. You're not going to buy back shares. We are going to influence you from, and prevent you from doing all of that.
Well, it sounds like the kind of Pelosi trade I actually like.
You know,
You're giving them the orders, when the orders come in, and you just want to wet your beak. You want to be in it.
well, I don't know what that does to the share price, whether people like it or whether they don't like it. But the bottom line is, because if you think about it, it will probably prevent share buybacks in these companies.
Ja, nur weil der Staat einen Anteil von der Firma hält, heißt das nicht, dass der Preis steigt. Guck dir VW an.
Ja, klar, aber der Staat gibt keine Orders raus für 50.000 Golfs. No?
Yeah, but if the when you look at all of these steps of this plan, and obviously we get the information in bits. We hear about the land sale. That was something that Bessent announced already in November, that he was going to take advantage of the asset side of the portfolio of US. And everyone said, "Oh, right, I know what that is. They're going to revalue gold." And it wasn't gold at all. Because he said later on in an interview in February, I think it was in Bloomberg, no, I didn't mean gold. I was thinking about something else. But don't worry about it. But interesting you talk about it.
I've forgotten with whom this conversation on Saturday evening. Was it Stefan? Was it you that Trump got very quiet suddenly about the full audit in Fort Knox and stuff like that?
We are still waiting for the report.
Yeah.
We don't talk about it anymore, right? It's completely off the cards.
We don't know. But the point is that was not necessarily part of their master plan, because I think that will come. In order to do that, they've got to get permission from the Fed, to convert these certificates that the banks hold at $42. So they've got to get permission, and I think they're just going to say, fuck it, we'll just wait for the new chief to arrive, and he'll just sign this piece of paper which we've got ready for him.
You still put me in a pickle. I want to quote Goethe. Da stehe ich nun, ich armer Tor, und bin so klug als wie zuvor. Yeah?
Yeah.
I see the logic in your points, but I really don't get my head around which direction that could take.
You know, you're not supposed to trade every day, right? And actually to warn people of volatility is actually a good trade.
Yeah.
Because that's your cup of tea. It's, you know, you get paid for that. You're the volatility guy. So, and I think that
Volatility guy who's bleeding at the moment on
don't worry, I've got some of those as well, but you need to have stuff that makes money as well. So exactly.
The
So
long volatility guy is bleeding.
yeah, indeed. So, you know, as I say, sorry to announce that I think this trend is coming to a pause, and the pause bit, whenever things are in this pause phase, you interviewed me in November, December, January, and February, and twice, I think, in between, once more in between. And every time I spoke, I said, I think the markets are going to experience, you know, a pullback because of this upheaval in the change in the policies of Trump for an equity market that is perfectly priced. And then everyone said, you know, you're crazy. I think I said 5,200. I was like, yeah, crazy, Nick. You know, November, I remember this, you'll find it anyway. Somewhere someone wrote a text on 5,200, you know, idiot. And Nick's the idiot, not the person who asked the question. Yeah, I mean, it was the idiot trade. But what happened in December? Well, still the market went a little bit higher. Then in January, the market went a little bit higher. Then in February, middle of February, I think the market peaked. And in peaking, you know, obviously we had this catalyst event, let's just say the tariff thing that finally broke the camel's back. You know, people say, oh, tariffs, you know, let's sell this market. We've still got the same tariffs, by the way, that were then. And the market's a lot higher. So tariffs wasn't the catalyst. The market was anyway ready for a cleanup because the market was overpriced. And I see that the market at the moment is overpriced. And therefore, we're likely, and we've got uncertainty. Do we have tariffs? Do we not have tariffs? You know, what's going on? What's going on with Ukraine? What's going, you know, the Chinese and the Russians and the Indians have suddenly got together and, you know, put more pressure on. I mean, all of these uncertainties and the we don't knows. And of course, let's not forget the growth outlook in America, which has not been priced to be, so that's not perfection, if you like, for the equity markets, that this is likely to see a sell-off. So for that reason, you know, I don't care when it happens. You know, I've liquidated the majority of my US equities, and I said to you in the last call we made in July, I think we're going to see prices lower than where I sold them. So on that basis, you know, if you get a better chance to sell it higher than where I sold it, or you're forced to sell it lower, you know, I just say that I think the reason to be in risk for the current market environment is not that great, because I do think that whether it's a month or whether it's whatever, I don't know when it's going to be. I think we'll see lower prices than where we are today. And when we see lower prices, then we can start to talk about, yeah, you need to ship it in because it's, you know, gone too far down and we need to buy this thing, all of this stuff. We can talk about entry levels. But for now, my message is what I said in July. It's no different. You know, I see more risk of deflation than inflation. And, you know, the markets are not bearish in a deflation sort of quad. So we're seeing, so why deflation? Well, inflation's not increasing and growth is declining. So that's Goldilocks. That's not in Goldilocks anymore. And even that was in July as well when I did the call. But it's not danger unless it moves further into that quad. Yeah, I mean, remember, it's not just being in the quad that's dangerous for markets. It needs to be deeper. And the deeper thing comes with, you know, it could just be that what might be the catalyst. It might be, you know, a payrolls number worse than expected, you know, something like this. Or it could be another one of these yen shocks of, carry trade unwind again. But, you know, that's all happening in the background. You don't see it every day because you're looking at the price of NVIDIA and NVIDIA's going up and you say, well, you know, it looks okay to me. And it does look okay. But the point is, in the background, there are a lot of people bleeding for the weakness in the dollar. Those people who have been invested from overseas, and there's a lot of political pressure on people, in my view, that is still taking place behind closed doors for supporting their own domestic bond market. There's no way that the Bank of England are just sort of looking and say, well, hey lads, look at the yield on the 30-year gilt. 30. They are phoning around saying, go buy this stuff, and getting your local MP to go speak to some pension guy to do it. That's all happening in the background, in my view, and that smells of the early stages of another, yen crisis, carry trade kind of crisis of old.
I think Great Britain 30 years, we'll have to see 7.5. You remember that? That's also a while ago when we looked at the 30-year chart, gilts, and I said, I don't believe in charts, but I believe in long-term charts. And we were at this level, and I said, if we break above the level we are now and start sitting there, then everybody wants to see how high can it go. And with the current situation we have in the UK, it's a shit show to happen, right? The old English saying, couldn't organize a piss up in a brewery.
Yeah, I mean, there's one more thing about the nuances about the UK gilt market. Obviously, historically, the buyers of gilts have been these pension funds that were kind of running these defined benefit plans. Defined benefit plan was having a pension which is linked to your salary. And of course, the corporates who set up these plans 20, 30 years ago were always, we're not going to invest here. We're going to invest, when yields are much higher. And of course, then we know that yields sort of came down for many, many years. And that created a huge deficit in these pension plans in the UK. So, these British Airways, all of these companies, nobody wanted to buy this stuff. That's why the stock market in the UK was always under pressure, because they say, well, if I buy this company, then I'm buying all of these hidden risks in the pension plan. Well, what happened was that everyone basically said to these pensions, well, maybe you should buy some equities. It's probably not a bad thing. And of course, they bought them always at the wrong time. And but nevertheless, there was a huge recovery in the equity markets last year, I think, where actually many of these plans were no longer in deficit, but are in surplus. What do you do when your plan is in surplus? You sell all your equities, and then you match fund your exposure with long-dated gilts. Well, if they've already done a lot of that, and I honestly haven't researched it, but I know from some of these pension plans that the demand today for long-dated gilts isn't like it used to be, because there's already been this kind of conversion, if you like, and for that reason, I wonder whether the dynamics of the long end of the gilt market is the same as it was 5 years ago. I think that's changed as well. So, you don't get the same kind of interest in the long end of the curve. So maybe we'll see your 7.5%. But what happens at 7.5%? Get another phone call. Go and buy
Well,
it.
let's put it that way. I'm not trading gilts, but what I really see is this danger of contagion, especially at the long end, when everybody starts focusing, oh shit, every currency in the world is America again, the cleanest shirt in the dirt hamper.
Go and have a look at the rise in yield since the beginning of the year, and you'll see probably that the lowest rise in yield has been the US. In fact, it's probably been the only one that's probably yield's gone down. I don't really know, but everyone else has gone up, and the US has gone down.
Well, from a technical position, you could see this huge correction then in the US stock market, and until everybody sees what's really playing and that you should be in the US again. How do I play it? Well, I'm saying it all the time. I bought this straddle when the market was at 6,072 or something like this, right? I'm getting older. I'd love to short it, but in the past, when I did that, I lost money. So what I'm doing at the moment is I'm slightly rolling it up every time with a little credit. So I'm making pennies. I'm not making as much as if I would put my money in the S&P. However, I did the last roll last week. We had this big gamma level at 6,500. And I thought, okay, fine, that's put a pin in that, because either we get rejected, or if we work that off, 7,000. So I rolled my straddle up to 6.5, again with the assumption that I'm long and at the money put if it hits us. A little bit longer term this time, up till November. But at least if the market keeps rising, I'm earning my theta in the whole thing, and I'm well positioned for the correction that will come in. And the levels you spoke about earlier, I could see that happening, yeah, 5,800 as a correction level, fine. Then I'm set.
And yeah, indeed. But as I also said in a number of videos that we did together, that as I'm exiting the US, and where do I put my money? I put it in China, put it in sort of some gold, silver stuff. I don't, and I put it in some bonds, and I don't care that I don't own Nvidia anymore, because Alibaba made 20% last week. So I think, okay, that suits me.
Hey, Google made 9 today.
There you go. There are some stuff that is worth buying, but my point is, I took the punt to say I'm going to leave the last bits of the rally to people who are sort of still looking to get into the US market. And yeah, you're going to miss some opportunities. And as long as I can make some money on the other side of the table, as it were, in China, China's done really well for me. They're still with all the geopolitical risks, but China's done well. As I say, the gold and silver are done phenomenal. So I said, okay, I don't have Nvidia and I don't have AMD and I don't have this, but I've got stuff which is kind of making up the difference. And if Google can go up today by 9-10%, good luck to whoever's got it.
That was a special Apple case, because they are still allowed to be the default browser on Apple phones, but they have to renegotiate every year. There was this concern that the courts could break Google up. So that is out of the window, and it made this big move.
Yeah, I mean, Google is a really cheap company. I mean, somebody did on Twitter a breakup value of Google. I mean, really, it's phenomenally cheap. And I mean, that was one of the drivers when I bought, Alibaba, was, some kind of analysis which says, well, if you're going to buy something which is cheap, and hope the catalyst comes, before the market takes you out. And it did. And the other advantage, of course, by overseas investments was, I wasn't sure whether the dollar would still, continue to form a base, or whether it would collapse further. So I said, okay, let's go out and buy some other currencies. Have you seen how much the Chinese currency has rallied? Whilst all of these people, even sort of people that I respect, Russell Napier, Michael Howell, both called for a huge Chinese devaluation. I'm saying to my clients, am I the only idiot here? Why should they be devaluing? And the currency has strengthened more. So I make money on Alibaba. I make money on, the Chinese currency. Okay. Fine. I missed the Google trade.
That wasn't really a trade, more surprise.
No. I mean, but that's the philosophy, to say, I know I'm going to miss stuff, but I'm saying it's the end of the rally, but I don't necessarily believe it's the end of the rally in the Asian markets. So for that reason, I feel more comfortable because I have a long stock portfolio. So where do I want to sort of allocate? I allocate more over there. I mean, I've got very little in the US at the moment, and as I say, it's kind of worked out. It's okay. I don't know how long I'm going to stay in this game, because when we do see any kind of sell-off, that will sort of hit everything, of course. And of course, the big one with the yen, when that eventually happens, you just have to get out the way of it. And I think that's where you want to get rid of a lot more of your stock investments. But as I say, I don't think that's for now. I think that's a little bit early next year.
What are your thoughts on gold and silver? Because our resident silver buck, Mr. Bully, he's played, I think, with impeccable timing, the zero cost collars on silver. You must be coining it right now, right?
So I thought that was a fantastic trade he put up last week with was someone being long of the $50 silver call with a hedge on a 35 or something like that. put, selling the put and buying this thing, getting 30 cents profit.
Can you see his smug face there?
I can see his Ferrari in the background. So
It's the
yeah,
blue one.
I think that is great to spot these, kind of I won't say no-brainer trades because everything's got risk, but I think if you're able to spot these things, whereas I haven't done that kind of analysis because I'm not really that deep into what's out there. So when I like silver, I just go and buy silver, or I sort of buy these out the money call spreads and stuff, and hope I get a kicker if it works out. But I've had silver, for bloody ages, so it's sort of nice that it keeps making money. So the answer to the silver story is that obviously you still like it because both gold and silver are still trending higher. Then unlike the stock markets, this is what I talk about, what is an easier trade to do. And an easier trade to do is to pick something where the trend is still up. And, if I, can I share again? Sorry, share. So this is, and then I make that larger. So this is silver, which for me is clearly still trending. I don't see any, volatile points. But as you can see from here, I'm labeling, I know not everyone's an expert in Elliott wave, but if you just imagine that each bullish wave has 5 waves to it, I'm counting that from here where I've labeled 4, I can count 5 subwaves around about the next high, wherever that's going to be, right? And that just means that somewhere up here, somewhere between the, whatever it is, 44 to say 50 level, just make sure Bully gets in there, we see this wave complete. Now, once this wave completes, you are either correcting the whole of this first wave thing, which let's just say I think is from down here to $17, or, so in other words, you see a massive sell-off in silver, or what is possible is that we're only going to correct this wave. So where I've labeled that as 5 and that as 5 in black, that eventually that is only the first wave of the last wave of this pattern. And so we only correct this piece. And if we correct this piece, well, then it probably sort of heads down to, I don't know, the, that's silly, needs to be there. That will go to, let's just say, can't see, oh, damn, that's in the way, that's fine. Somewhere around here, let's just say mid 30s as a more realistic downside target for this leg of silver, because the difference between silver and equities or commodities like gold and equities is that, I think I've said this before, is that equities are driven by greed, whereas commodities are driven by fear. And so what you tend to see in the commodity markets is that the 5th wave of something is actually, normally in equities, the 3rd wave is the biggest wave. But in commodities like gold and silver, the 5th wave is the usually the largest. And when you see that, well, you correct down to, let's just say, somewhere in the high 30s, let's just say, or down to 40 or wherever we get to, don't know. And then this thing starts to have the fantasy of the big moves higher into the $70, $75, which is still on the target of a lot of these silver buffs. One of my reverse Fibonacci targets, which is I will always do on stocks, on any kind of instrument here. Let's just see what that is. Let's put it up now so you can see it live, as it were, from here to here. Okay, we actually sort of reached the Fibonacci level. That was down here, the reverse Fibonacci. We're now at the 1.618 target of this length versus this length. And this length here, this point here at 42.17, also coincides with another Fibonacci target, which is the length of this wave 5. So it could be just the wave 1 versus the length of this thing, which is sort of how analysts, Elliott wave analysts tend to look at it. They look for symmetry in the wave patterns. So 42.17, 42 thereabouts, give or take, is likely to see some resistance. That's all I can say for silver. And gold. Is that gold? I actually think I've on this chart for this. Yeah. Look at that. Reverse Fibonacci level up there, which I've had for a long time. This goes to, what's the high there? 3,670 and, 3, I can't see that because the number's there, but, it's very close to where we are, I would say. So that's an important level and likely to see some first resistance. But like silver, silver went to or is likely to go to 1.6%. So here you can see the levels here, 3.6 to 3.650, and 1.6 level is 3.756. So that's the area where you would expect some kind of resistance. Realistically, we talked about earlier in many of the videos, gold had a high for many years at $2,000. And when you break a multi-year high, what happens is you tend to double the price of whatever that high was. So my kind of target anyway for gold is 4,000. Whether we see that in this move or another move, I don't know, but that's a realistic target. Does that help?
Sorry, I had my microphone off. Especially with this breakout, how do you sort that in now in gold? We see new all-time highs again, and it seems to have some
legs.
Yeah.
Yeah, I mean, it's you like markets which trend, and gold is trending. So you would buy gold, or you would have bought gold at the end of wave 4, which hang on, I've stopped sharing, I think. So here was the end of wave 4. That's the triangle. So you would buy at the end of wave 4 with a stop here at that level, which was 3.2. So that low was 3.268. This one was 3.250. So for $20 risk, you would have been buying gold here. So I don't chase. If you don't buy here, then I don't buy it. But basically, this is a trending market. You can see these moving averages. That green one is 200 days. The blue is 100 days. The red is 50 days. There's no sign of any kind of reversal. If I look at a DeMark thing on gold, I'm not sure if I can do that on this.
It could be the harbinger of a pending shit show in the rest of the markets, this breakout, right?
Well, yeah, or it could be the last hurrah. I mean, I just don't know. Excuse me. Bless me. So let's pull up gold. Gold against this. Yeah. So on the DeMark thing, there's it tried to register a high $50 lower. There's nothing new. There's no sign of a top, but it doesn't look like the wave pattern is complete because remember that bullish. So if I think I'm sharing this thing. So bullish waves look like this. Now, how many waves can you see from here? From where I've labeled 4. So I can see 1, 2. Some, I don't know if 3 is finished. So we are here, let's just say, in the map of what one wave would be. This might just be wave 1, and then wave 2, and then wave 3 up. So we're about there. Can you see my cursor?
Yeah.
Yeah. Okay. So just looking at the structure here, that's not complete. It's an incomplete structure. This is three swings, if you like. And even if you're counting from here and saying, okay, there was some dodgy sort of triangle thing, you're picking that low here. You've got one wave, you've got this, you need correction and then up. So at the moment, I don't think necessarily that is the high point. But if on my chart, I'm calling this, so therefore technically I've got to count this as 1, 2, sort of working 3, 4, 5 into this box, and then possibly reversing, correcting. And then the correction is the correction just this bit? And more likely it is. So then you go down to 3,480, and then you buy the dip, and it takes up to 4,000. You like things that are trending, whereas things that are noisy, like sort of at the moment, stocks and maybe Bitcoin, a bit too noisy, and not yet confirmed that what we saw as a sell-off is the end of that sell-off. So, we have to see more price action.
Just trying to spot a little bit what's happening in gold. Give me a second. All strikes. If I see something, I'll tell you. Volatility to the upside. Oh yeah, it's getting steep there. All right, I haven't done analysis, but first sight, it looks as if vol to the upside of gold is building up again, which means people are panicking that they can't get enough gold, which for the short term seems to be a good sign.
Driven by fear, not greed. Yeah. So people need gold. Yeah, because they need to hedge their currency. Oh my God, I'm long at the dollar, and this dollar is going to sell off even more. And as I say, I think the stories are beginning again in the currency space. So we got it right with the dollar weakening. Dollar stabilized. I even tried to buy dollars, but I got out of them fairly quickly. And right now, the way that I see the fortunes for the dollar is for if you think there's going to be more rate cuts because Jay Powell's successor is going to cut another 50 to what's expected, blah blah, then the dollar will weaken, and for that reason, let's just say only down to 94 in the Dixie, so it's another 4 or 5%. Maybe that's the impetus for more gold rally, and that's where the volatility. And so right now, by the way, I'm actually sort of playing more currencies. So I'm long of Aussie, I'm long of yen. It's a really interesting world, I must say. Much more, when it's just because the bloody S&P I haven't got an answer on the S&P, doesn't mean I do nothing. There are plenty of things out there that you can look at. As I say, either it might be a Chinese stock or it might be, foreign currency. There's another place to play that game whilst you're waiting for something in a sector that you like to play. And so I do a lot of that, I must say, when I'm, at the moment, as I say, S&P is a bit too up and downy for me, a bit too overpriced.
Let me thank you here, because I'm going to definitely cut that and make a gray market talk out of it. Yeah, well, hey, we've done it. So to all our viewers who've seen it till here, we now cut here, and I want to open the floor for our colleagues to ask questions to Nick. So I hope you enjoyed this impromptu thingy.
So was that a grey market talk then?
Yeah, of course. I'm recording. I'm going to cut that and push that out as a grey market talk. And now I'm.
Did I slag anyone off?
What?
Did I slag anyone off?
No. You were absolutely.
Because normally I'm a bit more sort of respectful,
very decent
of Fed chairman and.
Good. So say goodbye to the audience on YouTube, Nick.
Bye, audience.
Bye. And now the floors for our students. Lovely seeing you again. Bye. So,
Bye.
Gentlemen, hat irgendeiner von euch Fragen?